The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, the recent February CPI report from the U.S. shows that while core services and shelter inflation eased, rising goods and energy prices will keep inflation persistently sticky, even before tariffs and immigration policies further impact prices. Now, this report may just confirm that the Trump-Re-flation is underway, as tariffs and labor constraints drive inflation higher, ensuring long-dated U.S. Treasury yields rise despite the 47th president's push for lower rates. And while we see a sticky, slow-burn Trump-Re-flation, we could see an upcoming Trump Stagflation. So how should investors prepare for a stagflation, and should investors readjust their portfolios? What asset classes may strive during this economic landscape? Well, to find out more, joining me now is Laurent Lequeu, who's an independent financial consultant and the writer of the Macro Butler newsletter. Laurent, welcome to the show.
Hi, good afternoon, Hongbin. It's my pleasure to be back on your show.
Thank you so much for joining us once again. Laurent, the second U.S. CPI data released from the Jubilee year rose by 0.2% month-on-month, below expectations of above 0.3% and January's 0.5% increase. What's behind the numbers?
We saw some seasonal impact, and also in February, transportation costs was weaker than expected, but on the other hand, food, energy, and core services prices remain very sticky, and this comes even before that any implementation of tariffs.
I see. Well, does the first inflation reports, under the 47th U.S. president suggest that inflation is tamed, though?
Not at all, because I just said we haven't seen yet the impact of tariffs in this CPI data. We will see this in the next few months, so we should be ready to see a reflation coming over the next few months.
I see. So, you did mention that the reports are without the tariffs. So, with the new inflationary policies, including higher tariffs and stricter immigration measures, will this change the whole trajectory?
At the end of the day, someone has to fit the bill for tariffs. So if it's not U.S. corporate, it will be U.S. consumer. So higher input prices will need to be reflected in higher selling prices, and that's why we see the Trump-Re-flation taking place over the second quarter and beyond.
I see. Then can the 2% inflation target be achievable? If so, when?
If you look at the base effect and the outlook for the rest of the year, in fact, to achieve 2%, CPI month-on-month change need to be below 0.1% for the rest of the year. So it's very unlikely that in a world of tighter tariffs and tighter immigration policies, we see such low month-on-month change. So the base case for everyone should be around 0.2 to 0.4% month-on-month change for the rest of the year, meaning that CPI could easily end 2025 between 3 and 4%.
I see. Well, with the looming Trump-Re-flation then, how much will, the current Trump tariffs add to inflationary pressures, Laurent?
Well, it's difficult to say because the situation around tariff is very fluid. And we all know that Trump is the disruptor in chief. But fairly, as I just said, I think that input prices will need to be reflected into higher consumer prices, and therefore investors should get ready to see higher prices. On the other hand, and I think this is also important to mention, these tariffs create lower confidence among consumers and among businessmen. So this impact also economic growth at the end of the day.
I see. Well, on that note then, Laurent, could we see a stagflation coming soon, and what will that mean for markets?
If you see reduced investment from entrepreneurs and aim of consumption in the next few months, this coupled with higher prices because of tariffs and tighter immigration policies, this would mean that all the ingredients for the Trump stagflation will be in for the second half of the year and for 2026. So the scenario of a stagflation is in fact increasing by every month.
I see. Well, then will that have a negative impact on markets?
Actually, stagflation is a very difficult environment for investors, so this will need investors to be nimble and to reallocate their portfolio accordingly, meaning that what worked in 2024 and 2023 is unlikely to work again in 2025.
I see. So how would you, approach investing in stocks during stagflation, especially in sectors that are more sensitive to inflation and economic slowdown?
If we look back at the recent history of stagflation, in fact, investors should avoid to have exposure to growth stocks and should look more towards a value stock. What is important in a stagflation is to focus on stocks with low leverage of their balance sheet and a high ability to pass through higher input costs to their consumer, and also on stocks that are able to generate a positive free cash flow across the business cycle. So quality will be much more important than anything else in the next 6 to 9 months.
I see. Well, other than stocks here, are there any other specific asset classes that tend to perform better in a stagflationary environment?
Well, again, if we look back at history, and particularly the 1970s are quite famous for their stagflation. In fact, gold performed very well during a stagflationary environment. So I think this is another tailwind for gold price in 2025 and beyond.
I see. Well, other than gold here, Laurent, what role do bonds play during stagflation, and how would you approach investing in government or corporate bonds in this scenario?
I think that for a bond investor, they must focus on duration first, and they must focus on bonds with a maturity of less than 12 months, and also on the quality of the issuer. So what matters here is that for sure investment-grade US dollar bonds with a maturity of 9 to 12 months will outperform long-dated bonds and outperform junk bonds.
I see. Well, overall here, Laurent, then what steps should investors take to manage risk during stagflation, considering both inflation and economic stagnation are concerns?
I think that what investors must remember is that during a stagflation, the volatility in financial markets, both equities and bonds, is rising, so they will have to be more humble and nimble in the way they trade, and they be very focused on the quality of their investment, as well as to stay, I would say, away of the curve and avoid to follow the narrative of buy the dip. The dip can be deeper than previously in this stagflation.
I see. And before we let you go here, Laurent, is there anything else you'll be looking out for in the coming weeks that could affect markets?
Well, I think that another key driver for markets remain the geopolitical situation in the Middle East and Eastern Europe. So any development, positive or negative on that matter, will add or reduce volatility in financial markets during this period.
I see. Well, thank you so much, Laurent, for your time and your insights today.
Thank you.
That was Laurent Lequeu, who is an independent financial consultant and writer of the Macro Butler newsletter. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.